doing DeFi, greatest in the world, and they finally about to see why. What you know about XRD? I'm smart money, I ain't never on a decline. What you know about NFTs? It's not just Ace, when you finally gonna realize you need scalability, need more utility, then you better call on these guys. I'm going radical, I'm going Radix, I'm going radical, I'm going Radix. Hyperspeed DeFi, never on a decline, building the future, I feel like a savage.
Hello and welcome. I am Piers Ridyard, CEO of RDX Works, a core developer of the decentralized finance protocol Radix, a public ledger entirely focused on bringing DeFi into the mainstream. This is our podcast, The DeFi Download, a show about decentralized finance and all things crypto, where we dive into the details of the projects, assets and services that are powering the DeFi revolution. Today, I have David Gari, founder of Raft. Raft is a MakerDAO-like stablecoin, but backed by liquid staked tokens. Launched a month ago, Raft already has over $65 million of TVL and has 33 million issued stablecoins already. And it is backed by industry-leading investors such as Lemniscap, Jump, GSR, and Wintermute. David, thank you so much for coming on the show.
Thank you very much for having me. Maybe I can do a quick intro about myself so you guys are more familiar. Sure. I think, so Raft is an LSD protocol. What that means on simplest terms is that we take liquid staking tokens, for example, staked ETH, and Lido staked ETH is one example, or Rocket Pool ETH is another example. You can use those coins as collateral, and you can mint our own native stablecoin called R. And luckily, we have managed to get pretty good traction over the last month.
So basically, in Ethereum, you've seen this sort of like increasing adoption, increasing interest in liquid stake tokens, right? So people who want to stake tokens in Ethereum but don't want to lock up their capital. So what they're doing is they're providing Ethereum to these staking derivative providers like Lido, where you will essentially provide them with Ethereum, and then they'll provide you back with representations of staked Ethereum. And now you have these liquid tokens, and so people are like, well, I want to use these as collateral. And so you guys have taken the view that, hey, we now have these yield-bearing instruments that we can then make stablecoins out of, and we can create completely decentralized stablecoins for anyone who's familiar with MakerDAO using CDPs, collateralized debt positions, where you can take your staked ETH, put it into a CDP, and then you can mint a representation of dollars. Why did you think that there was why did you see a space in the market? Why was this the right time to sort of launch this new product?
I think there's multiple layers to that. The first and most important thing is that liquid staking in general, staking participation on Ethereum is still very low. I think it's something like 18% at this point. Mm-hmm. But if you look at the deposit queue, people are waiting to join and become a validator for Ethereum. And not a lot of people are withdrawing, and I think it's going to grow. If you look at other proof of staking protocols, participation in on different blockchains other than Ethereum is way higher. So it's not just 18%; it's 70%, 80%. Sometimes it's even higher than that. Mm-hmm. So if we expect similar numbers on Ethereum, then we can think that I would say that this is a huge opportunity for anybody who wants to integrate and give use cases to these tokens, since I would expect this 18% to go up to the higher double digits, 50, 60, 70% over the next 5 years, which creates a lot of opportunity to use these coins in DeFi wherever you want. So staking participation is growing, and then in addition to that, liquid staking participation is another thing. So still to this day, most people choose to stake their tokens with a centralized provider, run their own nodes, and basically in that case, they get no representation on the blockchain of their staking position. This is the problem that Rocket Pool and Lido are solving, and we can see that as staking participation grows, liquid staking participation is also growing. It is still a small percentage of the total amount being staked, but we expect that to grow exponentially from here as a percentage of the total Ethereum ETH being staked. So I think, like, if you look at the industry going forward, hopefully there will be a a big boom over the next couple of years.
So how much do you worry? I think this gets talked about a lot already, right? Which is that the way in which liquid staking is done on top of Ethereum is inherently sort of pushing Ethereum towards more centralization, in that you essentially go from a decentralized. The Ethereum's whole goal was to make the network as decentralized as possible, to make it as easy to run a node. But now people, in the bid to get liquidity, are staking their Ethereum with a very small number of providers, essentially Lido and Rocket Pool. And now, if you bring in a DeFi application that allows you to use that collateral and then take that leverage up that collateral and use it within DeFi, you're providing more opportunities for those staked derivatives. That's great on one hand, but on the other hand, you're actually helping to accelerate the centralization of Ethereum and the risks therein. What would you say to that?
I think one thing that we just have to do as a community as a whole, and this applies to any sort of Raft-like protocol out there or anybody else who takes these tokens as collateral or uses them in DeFi, is to make an effort to integrate with as many liquid staking providers as possible, and then let the market decide what they want to do. So we don't want to interfere with the competition, as in we prefer one staking provider over the others. We want to give people an even opportunity to use whichever collateral they want. So we started off with Lido staked ETH collateral as the number one. Obviously, at this point, I think it's like $13 billion of market cap. It's a huge market leader. And then expanded to Rocket Pool ETH, and then we're going to expand to other smaller providers in the future. What we want to do is to create like an even playing field for people, and then work with them equally without specifically preferring one or the other. And then hopefully that will encourage more competition, and then see where we go from there. One thing that is important is, luckily, protocols like Lido, even though they gather a lot of the ETH that's being staked, they use a bunch of different validators at the same time. So I think they have hundreds of validators that they split the deposited ETH in between, and that helps with decentralization. But obviously, it's not good that if all of this is controlled by a single protocol and by a single DAO, which is subject to all sorts of attacks. But yeah, we just want to encourage competition as much as we can.
Got it. Okay. So you saw this primitive that sort of is taking at the moment, the Ethereum world by storm. Obviously, this is going to extend to other networks. On Radix, we already have liquid staked tokens as a primitive of the network. So there is no need for something like Lido. When you stake, it is already liquid. But I think this is going to become a very popular token type, and it's clearly growing very quickly, and its use within DeFi is going to expand as well. Do you think, I suppose the obvious question is, in many ways at the surface, your protocol looks very similar to MakerDAO, right? So what is to stop MakerDAO just going, okay, we're going to accept LSDs as collateral. You can come here and you can provide your LSDs to MakerDAO and print DAI.
In fact, you already can. So you can use Lido staked ETH collateral in Maker. So you can do that, but doing so carries a whole different level of collateralization requirement, and the fees are way higher. So one of the key ways that we differentiate ourselves is, instead of offering a collateralization ratio that at this point is 175%, that's the requirement. So if you want to borrow on Maker 10,000 DAI, you would need to provide $17,500 worth of collateral at least, or more. You would get liquidated at that point. So you would basically want to keep your collateralization ratio at like 300%, something like that, to keep you safe from being liquidated. The other thing is that at this point, Maker has raised their fees for borrowing DAI to 3.75%. So that's an annual interest rate that you have to pay consistently over time to borrow DAI. And then if you want to obtain leverage on your staked ETH, first of all, you would be exposed to this very high collateralization requirement, and you would also have to pay these high fees at the same time. So that's not very optimal. And in fact, we already see that there's millions of ETH being used this way to leverage up. So people are willing to pay these fees regardless. But if there was a solution that is cheaper, more capital efficient, and prefers longer term positions over shorter term leverage, we have built a protocol just for that. So the problems that we solve here is the collateralization ratio, the requirements it's way lower. So it's 120%, which means that you don't need to have that much collateral and you can have a more capital efficient leverage position if you want to. So if you want to have 200% collateralization ratio, double, say you want to borrow 10,000 R against $20,000 worth of collateral, you would only be liquidated like way later. So it allows for a way bigger drop until you lose that excess part of your collateral. And then the one-time fee that we have, instead of a consistent APY that you have to keep paying on your DAI loan, it prefers longer-term users, and it just encourages people to take out longer-term loans because you can, borrow R in this case, pay a 0.5% fee or 1% fee depending on your collateral, and keep that loan open for as long as you can, or as long as you want, without paying additional ongoing fees.
Let me come back to the fees. I suppose that the question I have on the collateralization ratio is obviously a lot. DAI and MakerDAO have been tested through some pretty severe markets, and generally speaking, the risk management, as I understand it, of these stablecoins tends to look at what's the secondary market liquidity during stress events for us to be able to know that we'll be able to liquidate positions quickly enough before they move under their peg. What you're doing by reducing the collateral requirement is you're bringing it closer to the point where you essentially have less time to respond to the market before you fall below collateralization ratio. That would mean that the thing goes into debt. And the other thing is now you're using LSDs, right? So Slido staked ETH and Rocket Pool ETH, both of which are far less is unfair. They are less liquid than Ethereum, right? So now you have a less liquid token, which has actually already broken peg with Ethereum a couple of times, right? There have been a couple of points where Lido staked ETH has moved out of sync with the price of the underlying, which means that there's clearly some market inefficiencies in that underlying asset. So how are you guys managing that increased risk, both of the underlying assets being less liquid and reducing the collateral requirements such that you actually have to respond faster in a market stress environment to avoid breaking the peg of your issued R tokens?
Yeah, there are a couple of things here that we could unpack. The first of all is the actual the actual liquidation mechanism that Maker uses is very different from our liquidation mechanism. So on Maker, you have an auction mechanism for this, which makes sure that people are not over liquidated, people get ample notice, and then that's why the penalties for liquidations are kind of low. On our side, we made a conscious design choice to have instant liquidations instead of having this auction-like mechanism. So what that means is that the moment that your collateral falls below 120% in the next block, as soon as the price feeds update, you can be liquidated straight away. The reason why this is important is that even though you get liquidated at a later point, so closer to your closer to 100% collateralization, you get liquidated for all the excess collateral. So basically, you would lose 20% of your position. Why that's important and why this is a conscious design choice on our side is that we allow people to leverage up and then have a very concrete number, and they know they're going to be liquidated at that point, and at that point they lose more. So it's like, which one does the market prefer? Do you prefer to have 150% and enter this like soft liquidation mechanism, or 175 and enter this like soft liquidation where you kind of lose some of your collateral, start to lose it, you get some notice? Or would you prefer to be liquidated at 120%, but then you're hard liquidated like straight away? similar to what you would do in a centralized exchange.
Saying, just so I understand it correctly, you're saying that as soon as you hit 120%, you get liquidated, and whoever claims that gets you. Essentially, cost of liquidation is a 20% penalty on your collateral.
Yeah, it basically depends on what the collateralization requirement for that collateral is. If it's 115%, you lose 15%. If it's 120%, you lose 20%. So it's all the excess collateral is being split between the protocol, so part of which will go to the DAO and part of which goes to the liquidator. So that's like an instant liquidation is a conscious design choice. And if you look at this number, this 20%, this is what actually matters. It's not the collateralization ratio, whether it's closer to 100 or above 100. This 20% is higher than any other protocol out there.
Yeah.
So it's just like we're making sure that all the positions get taken out immediately. And if this works out and we see, market going down, going up, we might tighten this in the future. So maybe we go from 120 to 115 over time, and we can respond to all sorts of market situations. So that's like one of the things. And then the other thing is just like, obviously, liquidity constraints on Ethereum mainnet is an issue for some sort of collateral that we take. For Lido staked ETH, it's not necessarily an issue right now because we can easily liquidate positions, or liquidators can easily liquidate positions that are $20 million. Like you can just go and take it out in a single swap because there's so much liquidity out there.
$20 million sounds a lot right now when you've got $66 million under management.
Yeah.
But like when you get closer to what MakerDAO has under management, $20 million isn't as much.
Yeah, for sure. And this is where the caps come in. So we have caps for minting on a position level and caps on a protocol level as well.
Right.
So we have limited the amount that the size of your position that can go up to, and we can potentially increase this in the future, but it's kept within sort of like conservative bounds for now. Right. To make sure that there is enough liquidity.
Kept within your assumptions or your actual knowledge of current market liquidity.
It's based on current market liquidity. So we would double check, run simulations, or we can double check, just basically go on 1inch and see what sort of price impact a trade of a certain size would have. Let's say if you want to swap, let's say it's $20 million worth of R for staked ETH, and you can see the price impact of that would be like 2.5%. If a liquidator comes in and they can make a 20% profit doing so, a 2.5% price impact is not going to make any difference. They can take that position out immediately and still keep like 17.5% profit, which in this position would be a several $1 million liquidation gain for the liquidator. So just but it requires some constant monitoring on our side and responding to these sort of things, but it's kept at a very conservative level for now, and then we can potentially increase these limits as we start to get more liquidity on Ethereum mainnet. But this is part of our ongoing strategy. So the reason why Raft is on Ethereum mainnet and it's not on Arbitrum and it's not on Optimism and it's not on any other chain is Radix. Liquidity constraints, for now. But we'll see. Have to continue monitoring, and then we'll see. But there's we don't have, like $100 million of liquidity of staked ETH paired with another coin that you can just easily swap like that on another chain. But we'll see how that goes.
Okay, so let's. I said we come back to fees. Let's talk about fees, because I think the fees aspect of this is really interesting. So here's my argument for MakerDAO interest. Right, MakerDAO has the other part of the token of the system is the Maker token, and the Maker token essentially is the loss absorbency capital, your tier 1 capital, if you're talking about like banking adequacy rules, that make sure that in the event that a CDP breaks peg, so in the event that there isn't enough collateral because the market has moved too far for the collateral to actually cover the circulating value of stablecoins, then the Maker token is the token that comes in and essentially makes up the difference. And we've seen that happen already once or twice. I can't remember if it was once or twice, where due to congestion on the Ethereum network and the design of their auction mechanism, the Maker holders had to make up the deficit of some collateralized debt positions that has essentially fallen below market. Now, the reason for the interest rate, the 3.15% interest rate, or whatever it is that you pay as a creator of DAI tokens when you create a CDP, is that that's paying the maker holders who have millions of dollars of tokens in circulation for essentially being the insurance policy. That's your like deposit insurance policy. And what this insurance policy is ensuring is that DAI is always going to be 1-to-1 with the dollar, even if the collateral that backs up the DAI, circulating DAI fails. There's this second level of defense that makes sure that, but obviously those people who are holding those tokens, who are taking that risk, who are essentially insuring those deposits, should be paid in some way. And that's essentially what the mechanism's for. Do you guys have the same kind of mechanism? Is there a second tier of defense here? Or if it breaks peg, then sorry.
So protocol backing, for example. So what we need to make sure is that, the critical thing here is the hard peg mechanism. So for example, DAI cannot be redeemed for anything. It's just a guarantee that there is, at this point, it's becoming a USDC-like thing where you have, at this point, government securities that's backing it, and there's a promise by the DAO, and there's also regulatory risk. And in this case, people need some sort of backstop. And that's one thing. So regulatory risk is one that people need to be sort of insured for, and the Maker token and the value of that could be a good way of doing that and ensuring that people get more comfort. The second thing is just the liquidation mechanism. It's being designed with not having these extreme fluctuations in mind. So instead of having this specific backdrop for now, what we have decided to do is just to keep the liquidation fees way higher than any other protocol out there. So we're less likely to accrue any sort of bad debt than Aave, Maker, or any other protocol out there by paying liquidators more than anybody else and making sure that the liquidations happen even in the event of a big downturn, to make sure that R is always backed by $1 worth of collateral. So liquidations happen in every block as soon as the price updates, right? So that's one thing. And then the fees, I think like the ongoing interest is a good way to pay the token holders, and it's actually, gathering a lot of money. But I think it's just on the balance of things, Maker as a product and as a project tends to focus more on the ongoing fees rather than other fees. And in our situation, I think even though the minting fee is low, which would be 0.5%, 1%, something like that, there are all sorts of other fees that we expect the protocol to make most of the money on. And that would be liquidation fees, redemption fees, flash minting fees, and everything else. So liquidation fees and flash minting fees can provide additional revenue streams for the protocol and for the token holders. Instead of having these one-off fees, we have different kinds of fees, right? So instead of having the ongoing interest, we have different kinds of fees. And we expect to have like a lot of different use cases built on top of Raft. So you would have people who use our leverage functions as it's called one-step leverage. You can just leverage up on your staked ETH in a single transaction, use a slider that carries a fee. It's a combination of the minting fee and the flash minting fee, and that is automatically it ultimately, in my mind, comes down to building products that people want and then getting fees for it and then kind of balancing those. And in our case, the ongoing interest is out. There's a one-time fee, but it's substituted by different stuff. So that always will go back to the token holders in one situation or the other, and that will add up to all sorts of revenues. And about the actual backstop mechanism, I think the protocol is not yet decentralized, but it is in the works. We published our roadmap there, and we expect to have some sort of similar mechanism there as Aave does, as Maker does, to give more comfort to people who are the token holders. An additional thing that we have that also protects token holders is called a redistribution mechanism. What that means is that in case one position becomes under collateralized, there's a redistribution that can occur. So basically, if a position's collateralization ratio falls below 100%, that position's debt and collateral can be distributed among everybody else. So we basically socialize the losses this way and make sure that the protocol remains overcollateralized anyway, by basically ensuring that everybody else has to repay a little bit more. And this prevents all sorts of bank runs and everything else, and it acts as like a last line of defense.
Well, it doesn't necessarily prevent bank runs, because if I saw that coming, then I would want to front run that to get my collateral out. And so you would get a bank run essentially ahead of the state update. That means that everyone else pays for it. So my incentive, if I'm a smart actor, would be to get, as soon as I see that state update coming, would essentially to MEV attack that, or to bid my withdraw transaction ahead of that transaction, so that then everyone else pays more.
Yeah, I mean, I think I just meant that in the sense that you wouldn't want to, if this redistribution didn't exist, then the last person to take their collateral out wouldn't have anything left, right? And in this case, if we have this mechanism, once this function is invoked, then there's no point of trying to withdraw as fast as possible, because you wouldn't be better off by withdrawing as the first person as opposed to being the last person, because all the collateral is split between everybody evenly.
So you now have this cool stablecoin that has some really interesting properties in terms of lower collateralization ratios, which means you can get greater leverage, faster, more attractive liquidations, less fees in actually creating the token. So there's lots of things to like for people who are looking. I know that you've also got some flash minting capabilities, which we haven't spoken about, but looks really interesting as well. So the idea that you can mint something and then repay it in a single transaction, up to 10% of the circulating supply of the token, which would be $6 million at the moment. So some really interesting opportunities there when you combine that with DEXs. But obviously, a stablecoin doesn't stand on its own. A stablecoin has to be integrated with other DeFi protocols for it to be useful. So what's your sort of strategies there, and how are you guys getting on with that?
Sure. I think it's still early days, so it's hard to say where adoption will be, but there are some core considerations that we have to keep in mind, because I think there is a definite market need to address here. And that need is basically a stablecoin that has a stable peg and is backed by assets that are uncensorable and lives completely on chain without carrying any sort of regulatory risk. And while that's happening, you also want to have something that's the collateral that you use is capital efficient and everything else like that. So I think we're definitely addressing a market need here, but the question is, how fast can we sort of roll out all these new features, including, finding money markets and finding protocols where we can integrate R and take R as collateral. That would be a core use case, so that people can, that starts another level of adoption. Creating DeFi native or crypto native use cases for R would be a good thing. We're working with physical credit card providers and where you can basically spend your R. You can have let's say, I would just say a real life situation here. For example, let's say you're long on staked ETH, you have $100,000 worth of staked ETH in your wallet. Then you want to keep that. You don't want to sell off some of that to cover your expenses or living costs or something like that. But maybe you want to take out a capital efficient loan where you don't have to pay interest. You would just basically generate R stablecoin, and then you can use a credit card, a debit card, which is connected directly to your wallet, and spend the R for your everyday purchases in a shop. And then maybe when the price of staked ETH goes up, you can just repay it from the excess, and it costs you nothing pretty much. So these are the kind of use cases that we want to encourage, and this is where the future of DeFi is. The question is just how fast can we get there, and whether that requires a strategy in terms of L2s, bridging the coins to different networks so it's cheaper to do so, focusing on all these other stuff. I think that is crucial. We have already done pretty well in terms of like DeFi native use cases. So we have a $42 million TVL pool on Balancer that is used to strengthen the peg, create more liquidity around the $1 mark. And in general, that's like the backbone of all the liquidity that we have. And then, encouraging trading as well, and pairing R with a bunch of different coins is also going to be a strategy for us. And to make sure that this is the coin that people actually want to trade against would be an amazing outcome.
So do you see R's utility? It's interesting you mentioned spending first rather than sort of trading, because obviously the big stable coins that have come before, at least on sort of the USDT, USDC, and to some extent DAI, most of those, the biggest use case for those have been as trading pairs. And it seems like you're looking at a different market here. You're saying, actually what I want to do is I want to go after the people who want to stay long Ethereum but want to be able to spend their underlying currency. Do you see that as your biggest growth market then?
I think that's a niche. I mean, that's like a market that we can focus on as sort of like a better niche market, because there's so much stake ETH out there, and since that's our primary collateral, we can address this sort of need in the market. If we focus on the trade, I think the trading use case requires even higher capital efficiency. So it works well for USDT and USDC and DAI, because for those coins, you only need $1 of collateral to mint one stable coin, right? So to get one USDC, you need to send circle $1. That's how it works. In our case, we're basically limited by the overcollateralization, which is a conscious design choice on our part. But even if we keep the collateralization ratio at 110%, it's not going to be as capital efficient to trade with R compared to trading with a coin like a centralized coin like USDT. And given that most of the trading actually happens in a centralized way,
I would actually challenge that. I would challenge that. So like, it depends what people are using the token for, right? If I'm long Ethereum as my position, that doesn't mean that I don't want to trade short-term assets. And so my ability to be able to borrow against my Ethereum and then trade other assets using R, so provide liquidity, yield farm, all of this kind of stuff. I wouldn't want to go and get USDC or USDT because that would involve selling my ETH. What I want to do is I want to leverage up my ETH position, stay long on it, and then use the R to go and then trade short-term positions, market make, liquidity provide, all of this kind of stuff, in which I can I can exercise delta neutral strategies where I'm not actually taking any long positions on the market, but I'm still making money from doing so. Which seems like that's a key opportunity.
Yeah, I think that's a good point. I think that is definitely something that people would be interested to do. I'm talking about more in terms of like what bring good volumes to people. So in terms of a traditional market maker who's working on centralized exchanges, for those people, it would be a little bit harder sell to be exposed to the delta of a collateral that is a volatile one. So they would have to have, hundreds of millions of dollars of staked ETH to mint R with, and then use the R and then be able to monitor their positions and make sure they don't get liquidated, even though they don't want that exposure. And I think for any sort of centralized exchange trading, having a stable coin as collateral would potentially work. That would be a design choice on our part. So for example, we can think about if trading is in fact turns out to be a leading use case and a big driver behind the stablecoin, we can actually think about onboarding collateral types that are like DAI or USDC, or even interest-bearing versions such as DAI, so staked DAI that carries an interest could be onboarded as collateral. What we would need to do there is to keep a slight over-collateralization. So maybe that would be over-collateralized by 1% or something like that. That would make it 1% less capital efficient than using DAI itself. But we can actually get beyond that by offering a more attractive option to let's say we can offer some incentives, or we can use some some more attractive use cases for R to make up for that 1% inefficiency. And that would create a token supply that's extremely elastic. By using these stablecoins as collateral, we can basically jumpstart the supply. It can grow as much as possible since you can deposit USDC, while at the same time, since it's over collateralized, we still don't jeopardize the future of the protocol because those positions could always be liquidated anyway if it drops. So let's say the price of USDC drops to 99 cents. At this point, all of this would be liquidated, sold into the market, and it wouldn't impact the price of R. So that's a viable option out there. In fact, if you look at our governance forum, there is a forum proposal for onboarding as DAI collateral, which is the interest-bearing version of DAI that carries 3.75% interest.
Really interesting. I mean, super interesting conversation, super interesting project. And like, I definitely congratulate you on your sort of early traction, especially in a bear market, going from $0 to $66 million in a month is amazing. Yep. So, huge kudos for that. I think that you guys have taken some really interesting and sort of like strongly informed design decisions here, where you're saying we are charging more for liquidations, but as a result of that, we can guarantee a lower collateralization ratio, so you can essentially be more capital efficient by using our token, and as a result of that, the fees are taken out in another way for your backstop rather than having to charge this interest rate, which means that people can go long for a lot longer in your protocol. I think all of these things are really interesting. I'm really gunning for you guys to do really well in the next cycle. So thank you so much for coming on the show. People want to come find out more. Where should they go, and what should they check out?
I think probably the best place to go is to go on raft.fi. That's our website. You can find all the social links there. I think we're very active on Twitter and Discord. So if you want to get involved with the community, that's a great place to go. The website raft.fi has a bunch of information about how the protocol works, has all the features, fees, comparisons to different protocols. So you can check out all the interesting stuff that we have there. And we have a very extensive documentation on docs.raft.fi, which is probably the most comprehensive out of any protocol out there that works in a similar way. So you can find all the details, all the smart contract addresses, everything else there, including all the analytics dashboards, so you can keep up to date with what's happening in the industry, including us as well. But yeah, thanks very much for having me. It was amazing.
Awesome. Have a wonderful day, and speak to you soon.
Thank you.
More utility, then you better call on these guys. I'm going radical, I'm going Radix, I'm going radical, I'm going Radix. Hyperspeed DeFi, never on a decline, building the future, I feel like a savage.